Hi, I'm Jason. Welcome back. We've been sold a bill of sale that says we must pay fees to real estate agents, inspectors, title agencies, banks, mortgage lenders, surveyors, and more. We've been told that selling our homes to another individual is risky and dangerous, but that's simply not true. Not only is it untrue, but you're losing tens of thousands of dollars by not selling your home with owner financing. Let me show you why. Now, let me give you some context and preface this first. I'm not suggesting to anyone if you have a $1 million home that you should sell your home on owner financing. What I'm suggesting is if you have a second property, maybe one you have inherited, maybe it's a home that you and your family had lived in, and then you bought a bigger home, maybe you're renting it, whatever the case may be. This is an ideal scenario here. You'll make money, you'll save money on taxes. Final disclosure is, listen, I'm not an expert, I'm not an attorney, consult an attorney, do your own homework. I'm just a guy, all right? So for me, I bought 2 houses on quote-unquote land contracts. One of them was a full mortgage where the seller placed a lien at the courthouse and it was transferred in my name. The other was just a contract between me and the seller where the seller kept it in their name. Okay, and that's what I want to emphasize in this video is if you want to sell your house to a buyer, you make the rules. Okay, how much do you require down? What is the interest rate? All those things you can set. You need to have a discussion with the buyer. What makes sense for you? What makes sense for me? And let's put that in writing. All right, you do not have to follow rules here, but you do have to follow all applicable laws, and that's why you need to consult a real estate attorney and have them look over your contract. All right, so what rules should you consider? Down payment. How much do you want? How much do you need? Are you willing to split up that that down payment into like an initial payment and then 1 in 6 months, or in a series of payments over a number of years? You make the rules on the down payment, the term. All right, 15 years might be a standard term, but you can do shorter. You can do 10 years. You can do 5 years. You can do 3 years with a balloon. I bought a home personally that way where I did 2 years with a balloon. And then after the 2 years is over, we renegotiated that into a 3-year deal. So it ended up being a 5-year contract. All right. What is the interest rate? All right. Do you want to charge prime? Do you want it to be, prime is about currently in 2025, it's about 7%. Do you want to charge 8%, 10%, 15%? Do you want it to be adjustable rate or fixed rate? Do you want to charge no interest? All right. So when you're setting an interest rate, one thing you need to consider is that is going to be income. You're going to have to pay taxes on that. All right. Next, is it a purchase or is it a lease option? What are the terms? Right. So are you leasing it to a quote unquote tenant, and then if they fulfill that contract for a period of time, then they buy the house? All right. Are they paying you rent and a portion of the rent every month going towards the purchase? All right. So what are the terms? You define them. Is the seller allowed to get another loan against the house? All right, and I want to get into that a little bit later, where I suggest that you don't allow that. You want to be first mortgage holder, just like a bank would be. Will you allow the seller to sublet? Are they going to rent the house? Are they an investor? Will they be allowed to put it on Airbnb? Will they be allowed to have 2 roommates? You can set those terms. Subletting, we've already talked about that. What happens if the buyer is late on payments? Is there a late fee? How much is that late fee? What's the last date they can make before you turn it go into foreclosure? All right. So does it cancel the contract if they're late? So you can make any rule that you want there. What happens if the buyer defaults? All right. So you need to discuss with the buyer what happens if you stop paying. All right. Who pays for taxes and insurance? We're going to get into that. Who pays for improvements, maintenance, and repairs? Not you. If you're selling a house, do not pay for improvements, maintenance, and repairs. All right. But if that's something you want to agree to, that's fine. Who pays closing costs? All right. So at some point, if you agree to a contract that is a balloon payment, let's say you finance it over 3 years, and at the end of 3 years, the buyer goes to the bank, borrows the remainder of the money. There's going to be closing costs associated from the bank, and in quote unquote kind of standard transactions where there's a realtor and a bank involved, there are shared closing costs, such as the deed transfer and things like that. So you want to talk about that. And I want to drill down into it a little bit. But first, I want to show you why it's beneficial to you to sell your home in a non-traditional way. I am told that, in the 1900s, way back then it was pretty commonplace to buy a house on a land contract. Very common. Today we've kind of gotten away from that, where there's realtors and banks and title, all this stuff that's kind of this whole industry that's grown up around it. All right, but today folks have kind of gotten away from that. So let me tell you about some of the benefits, and let's just go with a very cheap house. All right, let's say you have a house, you think it's worth $50,000. If you list that on the MLS and a buyer makes the full price offer, all right, and you're not paying any of the closing costs, the buyer says, I'll pay the closing costs. Also, that's pretty common where the seller is paying a portion of the closing costs these days. All right, with maybe a full price or an overprice offer. You'll still walk away with way less than $50,000 because you're going to be paying a portion of the realtor's fees, which varies, from 3 to 7% or maybe even higher. And those are split fees between the buyer and the seller, but you're still walking away with less. You're going to have to pay some shared closing costs. So you're not walking away with $50,000. You're walking away with substantially less. And substantially, if it's $3,000 less, isn't that substantial? What would you do with $3,000? All right. Now let's backtrack that a little bit and say, what if you sell your house for $50,000 to an individual? All right, where you set the interest, let's say 8%, and you set the term for 15 years. Okay. So even if they don't give you a down payment, they'll pay you $477 a month, $477.83 to be exact, okay, over the life of the loan. All right, and in 15 years, they will have paid you $86,008.69. That's if there are no late fees, so on and so forth. So in just that period of time, you're making $36,000, nearly double what you sold it for. And obviously, that number escalates if you're selling your house for more than $50,000. And just for a moment, I don't have this in my notes, but I want to go on the side. All right. Buyers are willing to pay a premium to owners who seller finance. Okay, maybe on the MLS, you can only get $50,000 out of your house. If you owner finance your property, some buyers are willing to pay a premium, and that can be for a number of reasons. Okay, so $50,000 on MLS might equal $60,000 or $65,000 if you agree to owner finance it. That's in addition to the interest that you can charge. And there's a number of reasons. People may not qualify for whatever reason. All right, and that doesn't mean they're a bad risk. It just means they don't bank qualify. And there's a ton of reasons why you can't bank qualify. All right, it could be people with good jobs, good people, hard worker, they pay their bills on time, they still don't bank qualify. Could be someone like me. I'm an investor. I got a lot of mortgages, and I've got some personal debt, right? So anytime I go to the bank and I have to borrow money, whether it's my name or it's as part of the business, under the business name, then my personal credit gets dinged every single time. So every time I go to buy a house, that can show up on my debt to income ratio. If it's not a loan in the business name, it can show up on my debt to income ratio. So that impacts whether I can go finance other things that I want to do. So there can be a number of reasons why good people with good credit and good situations would want to buy your house from owner financing. All right. So that was a little tangent. If you have any comments, I'd love to hear that. Love to hear some comments and feedback. See what you think. But listen, I'm no fool. Money talks. I want to get paid today. All right? And more, what happens if the house burns down, Jason? All right? What happens if the person who's buying it dies? What happens if I die? Right? But those are situations you need to cover in your contract. And I want to go over that just a little bit more. So let's talk about protection. All right. First of all, you want to make sure your property is protected. Banks do it. And if you're the bank, if you're the seller acting as the bank, make sure that your property is protected. Have the buyer list you as the loss payee on the insurance policy. Make sure it's in the contract that they must carry insurance. Okay. Make sure that it's listed that you are the loss payee, and you can call the insurance company as many times as it suits you over the course of the loan to verify that you're listed as loss payee. You can even have it as part of the contract that every 3 months they have to send you a copy of their insurance showing that you're listed as loss payee, whatever would satisfy you there. All right. Secondly, another thing with protection. All right. When you sell the house, if you go the route where you're selling it as a mortgage, you'll want to file a lien against the property. All right. Like I said, I've done this 2 separate ways, and I'm not an attorney. It's going to vary by state. So you're really going to want to consult an attorney here. But I bought 2 different houses in 2 different ways. The first one I bought was basically a contract. All right. The seller kept the house in their name. I bought the insurance. I paid them the taxes every year. They would receive the tax bill. They would send me a text usually and say, "Hey, I just got the tax bill in. It's this much. Can you send it to me?" And I'll go pay it. And from a buyer's perspective, I had to verify they paid. I trusted the folks, but verification is always good. So as a buyer, you'd want to verify those taxes are paid. All right. So where was I? I'm all out of order now. All right. File a lien. If you do it the other way, right, where you transfer the title, transfer the deed of the property into the buyer's name, then you'll want to file a lien against that. And there are good things and bad things about both of these things. So, and maybe I got it in my notes. I am looking at some notes, so maybe I got my notes later on. But basically, if your document is a mortgage document, okay, and there are standard mortgage documents. I went to an attorney. They have a standard mortgage document. They just replace your name where the bank normally goes, and it lists everything. They put the lien against the deed in the state of Kentucky. That's a requirement. Only attorneys can do that. That might be a different video. It's very frustrating. But at any rate, if you go that route, if the buyer stops paying, if the buyer goes into bankruptcy, then you follow the same protocol as a bank would. All right, you'd have to foreclose. The house would be sold at the courthouse steps. Okay, so those are things to consider. Taxes. All right, so you only have to file taxes on the money that you earned this year. Okay, so if you're selling a house for $50,000 over the course of 5 years, and you're bringing in, and I'm just doing some generic numbers, $10,000 a year, you don't have to pay taxes on $50,000 in year one. You can pay taxes over a period of 5 years, $10,000 each year. Consult your CPA, not an expert for sure. All right. Income. All right. So another thing is, if you already have a primary residence, and this is your quote unquote extra house, it's a house you inherited, maybe it's a former rental, something along those lines. If you do it this way, you've got a guaranteed, quote unquote, guaranteed income every month, just like your paycheck. All right. So without the obligation of having a tenant or thinking about the tenant's going to move or having to go do repairs. So it's a tenant. It's almost like being a landlord, but you're just getting the money. You're just getting the good parts of it. All right. Property owners care for their property better than tenants. All right. Tenants traditionally aren't going to do a lot of maintenance. They may not, some of them may, but some of them won't. Tenants may not plant flowers or trim their shrubs or, paint the porch or something like that. People who have ownership value will do all those things. All right. So they will continue to care for your property. And if at some point down the road you do need to pull it back from them, you do need to foreclose on them, then the house is going to be in better shape than if there were tenants. Property taxes. I would personally, if I was going to sell a house, and I've never sold a house to someone as a land contract, but if I were going to, then I would escrow the taxes as part of the sale. So where the buyer pays me an extra amount each month, and I would pay the taxes myself. And you're allowed to collect, I think, 10% additionally every year for that as well. So you could escrow the taxes, you could escrow the insurance if that's something you want to do to protect your investment. All right, first lien. Stipulate you hold first lien on the property and no other loan goes ahead of you. Now, and this may vary by state. I know local laws. But locally, the bank, the mortgage is the primary number one lien, always. The only exception is taxes. If someone doesn't pay their taxes, that steps above the mortgage. All right. So if you sell your house on a mortgage and they don't pay the taxes, then the city or state or wherever the property taxes or whatever entity that's associated with can foreclose on the property. All right. Now, another thing is you can forbid, quote unquote, forbid the buyer from getting a second lien on the property. Tell them, as part of this mortgage, you're not allowed to get a home equity loan. You're not allowed to get a personal loan against this property. It cannot be used as collateral until this loan is satisfied. So you can make those sort of rules if you desire. And remember, I want to stress this. You write the rules. All right? You're not a bank. So you can write whatever legal rules there are and things that work for you, because banks have to follow a certain protocol. They have to follow, in some cases, laws that aren't applicable to you. But you make the rules and you can think outside the box. Hey, do I want $10,000 down, or do I want $3,400 down immediately, $3,400 in 12 months, and $3,400 in 24 months, and that satisfies the whole down payment, plus I can count on that big chunk of cash coming in, right? So that's just one aspect of thinking outside the box. All right, the negatives, and I've already touched on this. If the buyer could default, that's a real risk. All right, you filed a lien on it, the buyer can default, you'd have to foreclose. You'd have to potentially hire an attorney. You'd have to potentially go down to the courthouse steps and buy back your property like banks do sometimes, if you're able to meet some requirements for that. Buying property at an auction is a different conversation. Maybe I'll make a video about that later on. But if the seller files bankruptcy, they have, depending upon 7 or 11 or whatever they do, they have protections. they don't have to pay you for a period of time. You may have to restructure your deal. You can or cannot foreclose. You may have that expense or that headache later on down the road. What if whoever I'm selling it to dies? What if you die? Okay, put that in the contract. All right, because if you, for example, if you have grown children and they think, hey, you own grandma's house, and then when you die, they found out you settled on a land contract, they can dispute that. All right, and the same thing goes for the buyer. So make clear, and there's clear and concise language legally which can say things like, hey, if this, if the seller dies, then the descendants of that person, the inheritance is bound by this contract. All right, and if that's not there, that could potentially be a problem. And also, if the buyer has children or grown children and they die and they think mom and dad own that house, and it turns out there's a mortgage, then what happens? Are they going to pay you for it? Does it go back to you? You want to be specific. Talk to an attorney and find out what you can put in the contract. All right. So, kind of in conclusion, there are a lot of instances when selling a house to a buyer, being the bank will pay you much more over time. All right. Life happens. Things can go sideways. There is always a worst case scenario, and there's probably a scenario where you haven't even considered. All right, but that is the cost of doing any kind of business and making any kind of money. And if if we choose to err on the side of safety, then we're always going to get what we get. If you take some risk, there's an opportunity for you. And I think it can be a great situation for certain buyers and certain sellers together to make their community better, to instead of all that money going, to big banks outside of our communities, keeping that money locally. You're making a little bit of money, they're saving a little bit of money, and that builds a community. So that's all I got for today. Love to hear your comments and feedback. Bye.